There is always a lot of discussion in the investment community about whether or not investors should consider investing in funds versus single asset investments, and rightfully so. In this short Monday Minutes, I'm going to break down the strengths and the weaknesses of both and discuss my thoughts on what you could consider to do for your portfolio. Of course, none of this is financial advice, just my own personal thoughts on the topic. So let's start with the one that most people are more familiar with, which is single asset investments. Obviously, when you invest passively, you're giving up a bit of control over the entire investment because your intention is to defer to someone else who is an expert in their respective niche. At least that's the reason that you're deferring to their expertise. Now, for some people, giving up that control can be a challenge because they believe that really no one can do it better than them. Now, another way of putting that is, why should I give up almost half of the proceeds of the deal when I can just do it myself? Or when they're talking about investing passively, they can be concerned that someone's going to take advantage of them if they let someone else handle the entire oversight of that entire investment. Now, all of these concerns are certainly reasonable, but I believe that investing passively is incredibly favorable on a risk-adjusted basis, mostly because of the diversification, which is something that we'll talk about in a moment. So when you have a single asset investment that you're thinking about investing in, you are able to identify a specific property. You're able to conduct due diligence on that property. You can understand the market. You can analyze the pro forma. You can even look at it on a line-by-line basis and therefore get a much more thorough grasp of the entire investment. You can also get a much more thorough grasp of the risks associated with the investment because you can analyze each of those things. You can analyze the pro forma. You can analyze the market. Now, of course, needless to say, the main drawback with investing in single asset investments is that your entire investment is going to one particular property. That's one geographic location, one property manager, one asset class, one investment strategy, one operator. And even if all of these metrics are at the top tier of what's out there, the truth is, if you invest in 30 deals, you're going to see some variance, even if the people you're investing with know exactly what they're doing. From my perspective, within that paradigm, 5 to 10% of the properties that you invest in will probably have some sort of challenge, whether it be something like a large expense that comes up that wasn't originally accounted for, or some sort of natural disaster. It could be something that only disrupts cash flow for a month or a quarter or something like that. But these things take place because we're talking about real properties, real markets, real people. It's a normal course of business, and you have to assume that these challenges are going to take place. Now, when you invest in a single asset investment, you have much more control because you're able to identify those risks, analyze the property, but you're giving up the potential for diversification. Therefore, you're more likely to be susceptible to market variance. You're more likely to be susceptible to operator variance. And this is something that can cause not necessarily a lot of problems if you have a large portfolio that's invested pretty significantly, but from a headache standpoint, it's much more likely to be a problem. Now, over the long term, if you really know what you're doing, you're investing in good operators, you shouldn't experience massive losses, but you could see how cash flow could be disrupted. And if you're a passive investor who's depending on that cash flow for your income, diversification is absolutely key. Now, I think that's something that most people can wrap their heads around pretty easily. So let's talk about funds, which are a bit more challenging and especially more challenging to see the full implications of. Now, on the other hand of this conversation, you have funds, which the main benefit, of course, is diversification. Most real estate funds are semi-blind funds, which means that only some or one of the assets is already identified when the fund is launched. And that's usually when that people are considering investing. We'll talk about that more in a moment. But when it comes to diversification, like many things, there are levels to this game. Many levels at which that I believe that a lot of savvy investors don't fully recognize or don't understand the entire implications of. Let's say you invest in a fund which is intended to have 5 assets in several geographic locations. I think a lot of people think, okay, so we have geographic location diversification, and that way we're going to be very, very mitigated in terms of the challenges associated with natural disasters, for example. But it will also give you exposure to other markets. Now, despite what we have access to in terms of data, there's many, many people out there, many companies out there that have enterprise-level access to data. With that access, your goal is to try to get in front of the path of progress. That's how you get the best deals in real estate. You essentially identify a market that you believe is underpriced, where there's a price imbalance because you see growth taking place towards your asset. And you can buy an asset at a discount or what you believe to be a discount, as opposed to buying in a hyperprime market, which is likely overbought. But when you attempt to do that, you try to get a good deal, you're making a bet, and that bet could be incorrect. It could not play out the way that you originally anticipated. So when you invest in a fund, which is multiple geographic locations, the fact that you're getting into multiple markets itself does add a lot of value. Something else that I think people don't think about much is the property manager themselves. Sometimes as investors, we forget that the team on the ground plays a huge role in how the assets perform. So for example, are you investing with a property manager that's going to ensure that the maintenance team is answering their phone in the middle of the night if there's an emergency? Or do they instruct them to get back to them the following morning? Now, of course, this is a policy, but how is the policy actually being implemented? The difference between someone calling at midnight and someone calling at 8 in the morning to return a call about them being locked out, for example, those subtle differences are sometimes hard to get true transparency into how they're actually working, but those subtle differences can really be a deciding factor in whether or not a tenant renews or leaves. Here's a huge one that I've talked about that relates to this conversation: risk profile. Risk profile diversification is really, really critical, especially if you're building a large portfolio investing in syndications. Most investors want two things when it comes to their investments. They want predictability of outcome, which is usually provided through operational cash flow, rents, for example. And two, they want outsized returns. These outsized returns are generally provided through value-added strategies, really increasing the value of the asset, whether through capital expenditure or expense reduction. But that's really how you get the best of both worlds. Now, it is possible for you to achieve both of those goals in one singular investment, but it's particularly hard to do so late in the cycle. Usually, each investment has a balance of both, but if you want to really get the best of both worlds here, you usually have to choose an investment that is either weighted to either side of the spectrum, which brings up my point. Let's say you're looking at the totality of your portfolio. When you invest in an asset that is very heavily weighted towards stabilized, let's say it's a cash flowing asset, 99% occupied, that actually provides you with some stability and predictability in your portfolio, and it frees you up to invest in more value-added types of deals. So if you have one property that's 99% occupied, and you're looking at things on a risk-adjusted basis, you could incur some value-add risk by investing in, let's say, a self-storage facility that's only 60% occupied. Now, cumulatively, these two investments pair really well with each other, but individually, they may not really make sense. When you invest in a fund, you can see how you can invest in one investing entity, which could provide you the best of both worlds without trying to meet in the middle. You could actually be on either side of that spectrum with that same $50,000 minimum simultaneously. Now, of course, I could go on and on about different ways that the funds can allow you to be diversified, but I think particularly the risk diversification is critical. Now, many of you may be thinking there's a challenge with funds. Of course, there are, but the main challenge is that you're giving up that control for diversification. You're putting much more faith in the operator to do the right thing. So that's why it's really, really important. If you're going to invest in a fund, you need to understand as much as you can about the fund template and how the fund will be operated, and whether that template is legally binding or if it's just kind of written or kind of implied. I'm not saying that I won't invest in a fund unless it is legally binding. It's just good to understand what is actually legally binding as opposed to what the operator can do. So here's some of the things I want to look at when I invest in a fund. I want to talk about the buying criteria, the anticipated cap rate of the assets. What's the range of those cap rates? What are the legal limitations on purchases? So for example, can the fund invest in a development deal? If so, what's the maximum amount of equity that can be invested in development? What's the strategy? What's the range of the strategy? Is it stabilized to value add? How do they define that? What are the markets? What's the debt piece look like? Who the lender is? And is this, again, contractually binding? It likely wouldn't be contractually binding to work with one particular lender, but you just want to understand what the intention is, what percentage of this is actually legally binding and what percentage you're putting your faith in the operator to do correctly. The more ironed out these items are, the less I'm depending on an operator to do the right thing. Of course, if they're legally restricted, then it's significantly more limiting than if it's just, generally the idea of the fund is X. But I don't want the fund template to be so restrictive that it limits potential opportunities. Just enough so that I can thoroughly grasp the investment on a risk-adjusted basis, because that's what really this is all about. After all, how else can you decide if you're investing in a truly, quote, asymmetric opportunity if you can't grasp the risks of the deal? All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.